If you follow Caribbean energy, geopolitics, and the shifting balance of power in this region, make sure you subscribe right now. We break down what others miss, and today's story may look like it's about a tanker in the Indian Ocean, but it could quietly reshape the strategic future of Guyana and the entire Caribbean energy map. At first glance, this seems simple. The US military tracked and boarded a sanctioned oil tanker that had originally operated out of the Caribbean. The vessel was allegedly tied to illicit Venezuelan crude flows. It had been part of what analysts call a shadow fleet, ships used to move sanctioned oil through disguised routes, falsified flags, and ship-to-ship transfers. After being tracked from the Caribbean across the globe, US forces intercepted it in the Indian Ocean. Now here's the key question: what does this have to do with Guyana? On the surface, nothing. But in geopolitics, surface appearances are often misleading. What really happened here was not just a maritime boarding. It was a message. And messages like this reshape regional power structures. Let's zoom out. For years, Venezuela has operated under heavy oil sanctions. Its economy is overwhelmingly dependent on crude exports. When sanctions hit, the country didn't stop exporting oil. It adapted. A network of tankers, shell companies, reflagged vessels, and offshore transfers allowed Venezuelan crude to continue reaching global buyers, particularly in Asia. These operations were designed to bypass Western scrutiny. They were part financial survival, part geopolitical defiance. But when the United States publicly tracks a tanker from the Caribbean to the Indian Ocean and boards it, that changes the risk calculation for everyone involved. It tells shipping companies, insurers, commodity traders, and governments that the enforcement perimeter is no longer regional. It is global. Now bring Guyana into the picture. Guyana sits right next to Venezuela. And Guyana is not just any neighbor. It is now one of the fastest growing oil producers in the world. In less than a decade, it went from virtually no oil production to becoming a major offshore producer with billions of barrels in reserves. That transformation alone shifted the energy map of the Caribbean. But here's the strategic layer. Guyana's oil rise occurred while Venezuela's oil capacity declined. One country surged as the other struggled. That dynamic matters. When the United States tightens enforcement against Venezuelan oil, it doesn't just punish Venezuela. It indirectly strengthens alternative suppliers that are politically aligned and legally compliant. Guyana fits that description perfectly. If Venezuelan barrels become harder to move, global buyers must look elsewhere. If shadow networks collapse, legitimate producers gain pricing power and geopolitical importance. That means Guyana's value increases not just economically, but strategically. Think about it this way: oil markets are not just about supply and demand. They are about reliability. Investors, refiners, and governments prefer predictable flows over risky ones. If Venezuelan oil carries military interception risk, insurance complications, or sanctions exposure, then Guyanese crude, which is legally exported and backed by Western firms, becomes more attractive. But this goes deeper than markets. There is also the border dispute. Venezuela has long laid claim to the Essequibo region, a vast portion of Guyana's territory. The dispute intensified after major offshore oil discoveries were made near that contested area. When tensions flare between the two countries, investors watch closely. Now consider the signal being sent. The United States is not only sanctioning Venezuela, it is actively deploying military assets to enforce those sanctions. That implies a level of engagement in the region that goes beyond paperwork and policy statements. For Guyana, that changes the security equation. A Venezuela with constrained oil revenue has fewer financial resources to project power. Military budgets shrink when oil income drops. Political leverage weakens. Diplomatic flexibility narrows. When enforcement is global and persistent, the economic squeeze tightens. In contrast, Guyana continues expanding production, attracting investment, and strengthening ties with Western partners. The relative balance shifts further. Geopolitics is rarely about absolute strength. It's about relative position. And when one player is squeezed while another rises, the gap widens. Now let's talk about China. For years, Chinese refiners have been buyers of discounted, sanctioned crude. Shadow fleets often serve Asian markets. If US enforcement increases and the risk of interception grows, China may need to secure alternative long-term supplies. Guyana becomes relevant here. Why? Because Guyanese crude is light, sweet, and attractive to global refiners. It is also politically stable in terms of export legs.